Hello, everybody, and welcome to a new year, our first of the year. And happy to have David Arcara as our first speaker of the year. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter, which is filled with information for founders and investors too. And it's also first read of the tech press globally. And I'll put the link in the chat. I also help founders with their pitch decks and make introductions to investors and strategics where and when appropriate. In fact, my business partner is here, Deborah. She'll introduce herself later. And today we have David Arcara from Laconia as our guest again. But first, we want to thank Joseph Katz for hosting us. And Joseph, tell us about what you do.
Thank you, Bonnie. Thank you, everyone, for joining us today. Excited to be here. Happy New Year. Joseph Katz. I've been running marketing programs for startups for the last 15 years or so, focused on growth efforts, helping companies become big and going from unknown to well-known. Happy to chat with anyone about anything marketing related post this call. Have a great day, everyone.
So, David, you know the drill. Do you want to introduce yourself, or do you want us to go around the room and have the attendees introduce themselves first? Up to you.
Here, I guess I could start, and since you called me out, I'll do it. So, so I am David Arcara, co-founding partner here at Laconia. Just to give you a little background on Laconia, we are based here in New York City. We are a B2B seed fund. We've been around now for, 9 years. And my co-founding partner, Jeff Silverman, Bonnie mentioned earlier, he and I have been investing together for almost 15 years. So we're currently in the middle of our third fund. We don't have a industry focus. We're industry agnostic. We're really looking still for the digitization of manual and legacy workflow platforms, whether it's legacy software or Excel spreadsheets, which seem to be still very much in use in American industry. We discovered this thesis, probably about 12 years ago, and it still continues to keep on giving. American industry and global industry is still surprisingly behind the tech curve. And of course, with new technologies, AI, of course, gets a lot of the press. Those tech stacks continue to remain dynamic, and continue to develop new ideas and efficiencies around how business can do its work better and smarter. That's what we like to invest in. Typically, our round sizes tend to be sort of $1.5 million on the low end. They could be as much as 4. We've done 5 on the high end. Check size, low end 250, high end $1 million. What else? I'd say we're pretty focused on North America, Canada, US. We haven't ventured overseas yet. Maybe would be open to it at this point, but it would have to be very compelling. My background, as is my co-founder Jeff's, is as an operator founder. We're not bankers or finance people by trade. Laconia actually was the 5th company that either founded or co-founded. So we like to think we bring a little bit of execution knowledge to the table for our founders, and we try to be active investors with them, so we're not passive money. And yeah, I think is that good, Bonnie?
Yes, that was fantastic. Thank you.
Okay, all right.
So we'll have the attendees introduce themselves, and you have to keep it brief, guys, because we have a big room today. So I'm going down to the Sam.
Oh, wow. Okay. Hi, I'm Sam Bogosh, CEO of Axel AI. We are an applied AI company. Had a very good year last year, up about 1.2 million in revenues, largely bootstrapped with a little bit of equity crowdfunding so far, and look forward to hearing more about Laconia.
Ray.
Hey, Happy New Year. Raycon launching a digital platform that basically moves digital assets entirely on the internet with using your phone without any intermediaries, friction, or cost. What this allows us to do is do digital payments entirely disintermediating Visa, MasterCard, and the card rails, working with a major merchant association as of now to try to help local merchants and consumers with that major issue. Thank you.
Ian.
Hi, everybody. Ian Garmaze in Toronto. I'm the COO of Virtual Film School. We are a live online teaching program for people that want to become content creators, currently doing business in Canada and the Philippines, and soon in several other places.
Stuart.
Hi, I'm Stuart Silverman, CEO of Becco. We believe that every store associate, we believe that every shopper in physical stores deserves great customer experiences, and that every store associate deserves to get, wow, it's early in the morning for me, I'm sorry. I'm going to start over again if that's all right. We believe that every shopper in physical stores deserves a great customer experience, and that every store associate deserves to be recognized for doing the great stuff that they do. We've created a real-time in-store customer feedback app that allows shoppers to be able to rate the performance of the individual store associates that help them, and then use that data to help them do a better job in the stores.
You did it. Congratulations.
Yeah. Wow.
Alex.
Okay, I guess that's me.
Yes.
Hi guys, good morning. So I'm a filmmaker. I make a lot of content for companies, organizations to promote their brands, brand awareness, lead generation. And I'm also getting into content creation for my own site, which is kind of an alternative to Airbnb, where people who want to connect with nature can rent places outside of big cities, but not for short term, but more like long term, like a month or more than 1 month at a time. So I'm building that website right now.
Yes, thank you. Andrea. Are you here? I know you're here. Oh, you're muted. Maybe she can't talk right now.
Oh, no, I am here. I'm sorry about
Okay.
that. Hi, good morning, everyone. I am Andrea Liu, work for a Hong Kong family office looking at tech across most verticals and doing some market research in the Bay Area to see how AI will impact all these different industries. Good to be here with you all.
We're always happy to see you.
Likewise, thank you.
Steve Schreiber.
Good morning. I am a business operations consultant. I focus on the small to medium size businesses in the service sector, specifically in relation to customer impacting operational issues, and help CEOs and COOs and their respective management teams work through issues that are impacting their customers in a negative way.
Oh, thank you. Annie Wang.
Hi.
Hi
Thank
again.
you, everyone. I'm Annie, and now I am a project manager at the influencer media agency, and by day, and at night I am an influencer strategist. So I'm willing to talk and chat more about any trends in social media realm. Thank you.
Oh,
Nice to
thank
meet you all.
Brian. Oh, you're muted.
I'm muted. Good morning and Happy New Year, everybody. How are you doing?
Good, how are you?
I am wonderful. My name is Ryan Hurd. I'm the founder of Caregiver Smart Solutions, which is AI for aging in place. So we're a simple and effective way for caregivers across America to monitor, assist, and ensure the safety of their loved ones that are living on their own. It's time to have more peace of mind all the time. Thank you.
That's right. Deborah.
Hi, everyone. I'm Deborah Lee, and as Bonnie mentioned, I'm her business partner. We are Debonair Consulting. So Bonnie cleverly came up with the name Deborah and Bonnie, Debonair Consulting. We help prepare founders for funding, and we work on their investor materials as well as introduce them to our network of investors.
Oh, thank you. Brian Pearson.
First, thanks for having me. My name is Brian Pearson Jr. I'm the CEO of EDU Rain. We provide colleges with a white label software as a service and rental marketplace for their students and landlords to connect with both on and off campus housing inventory. We're a Techstars company. Demo day is on January 11th. We raised $405,000 into 2023 with over $2 million in revenue and LOIs. And we're raising a seed round right now of $1 million. And we just signed a partnership with Google to implement AI. Thank you.
Good on you, and good luck at demo day.
Thank you.
Eric Chan, it's always good to see you, and Happy New Year to you.
Hi, how are you?
I'm good. How are
Morning,
you?
everybody. I'm Eric Chan. I'm founder of Echo Design, and I am a product innovation company. I'm part of a New York Angel. So I advising and mentoring different kinds of startup from wearable technology, IoT, furniture, and energy sector. So glad to meet anyone and see anybody could be, working together.
Thank you. Oh, you should put your contact information. I should have you come speak too. Francisco, you're muted. Maybe you can't talk. Joseph.
Hello.
Oh, Francisco, go ahead. No? Joseph.
Hey, I'm a New Jersey-based real estate and angel investor.
Okay. Mark Weissman.
Good morning. Mark Wiseman. I'm a managing director with Navidar. We are an Austin-based boutique investment bank focused on doing sell-side M&A and capital raising for tech companies.
No, thank you. Neil, my buddy. You go way back.
Good morning, everyone. Happy New Year. Nice to see you, Bonnie. Neil Modi, founder of Headliner. Headliner.app is the domain. We help podcasts grow. We think the medium's amazing. It's still actually very niche. So we make products that really help podcasters get out to the broader web outside of just the podcasting apps. So we're used by all the big podcasting, the podcasts all the way down to Joe Schmo.
Sandra Connor. I got it right.
Yes, you did. Happy New Year, everyone. I am Sandra Connor, the creative force behind and the owner of videogrows.com, where we assist businesses with communicating what they need to make sure revenues and other funding sources come in their door on a regular basis, using visuals to convey who they are, who they serve, and why the heck anyone should buy from them.
Right. Tanya. Oh, you're muted, Tanya. Okay, Tino, I know you have no problem speaking to audiences.
Thanks, Bonnie. Hi, David. I'm running a company. I'm the CEO and founder of Baru, and it's a gig platform for underused manufacturing automation. So we use idle machines to deglobalize manufacturing to remove 40% of the industry's cost structure away. And we think Vistaprint meets DoorDash meets Uber for machines. We sell self-service custom cabinetry to dealers. So that way they de-risk their operations, remove all of their logistics out of their operations, and their customers get a more efficiently produced and economical custom cabinetry.
Oh, thank you. And Martin isn't able to talk, but he put his information in the chat. So, and I think we got Andrew, I'm sorry. You got here later. I didn't see you. Can you introduce?
Yep. I'm
Okay.
putting myself on here. Hello, everybody. Nice to connect for the new year. Andrew Bine. I'm at a startup called Brand Intros, where we help companies to present themselves, tell their stories to the trade, to their employees, to partners.
Oh, thank you. So, David, you're on.
Okay, where do you want me to go, Bonnie?
Oh, tell me about the investor land. Well, unless somebody has a question. We keep hearing about how investment has really slowed down. investors are being especially cautious and taking their time writing that check. So tell us.
All true. The first half of last year definitely was very slow, at least from our perspective. Things started speeding up again in the second half. We wound up actually only doing 4 deals last year. We typically will do at least a half dozen. Again, we don't do a ton of deals either. That's not our strategy in the market. But the Series A marketplace, and frankly later, has gone through a tremendous repricing. The seed marketplace was slow to reprice. Consequently, we didn't do a lot of deals. The reasons I think for that is the deal flow pulled back and there was just demand to allocate. But overall allocation last year, data of course supports it, was down, and our anecdotal perspective also reflects that. I think the bar for Series A's, and we're always focused on milestoning with our companies to get to the next financing, because that's the name of this game. If you can't raise, you'll die. So you have to be super well positioned and really understand what the triggers are going to be. And you still hear out there, I want to reach $1 million in ARR and then do my Series A. It is absolutely not that simple. And I don't think $1 million necessarily triggers anything one way or the other. Folks are looking at growth rates. You got to show that you're at least 2x year over year, and 3 is better. If you do have $1 million in ARR, you better have a pretty good pipeline behind that that gives confidence to a Series A investor that you can turn that $1 million into more than 3 within the first 12 months of receiving funding from them. So pipeline is really, really important. So it's definitely a challenging market in that way. Our perspective, we're capital rich, which is a nice place to be when a market reprices. We've always been very disciplined investors around valuations. We've passed on a ton of things over the last 2 years, frankly, that we thought were overvalued, and not to pat ourselves on the back, but we're seeing a lot of companies blowing up because they were. It's something we hammer home to founders who we meet, particularly first-time founders. The name of the game is to create value and build a venture scale business, which means you're hoping at least to have a multi-$100-million outcome. And if you can do that, frankly, whether you own 10, 15, 20% of the company at that rate, you should be pretty happy. If you can sell a company for $300-400 million and you own 20% of it, at least for most folks, that's a lot of money. So why overvalue yourself, which just sets yourself up, frankly, for failure, or at least gives you a lot less wiggle room. So these are things that I like to harp on. And it's not because I'm trying to negotiate a better deal. I just want all our companies to be successful. And goose eggs just are not great. And of course, we saw a lot of the larger full stack funds come down into seed over the last few years. For a large full stack fund to write $1 million check at a $20 million pre-money valuation to a company that has little to no revenue, they'll do that on the bet that of the 100 deals they do, a few will break out and they'll support those companies. The other ones they won't support. Even if they have a reasonably capital efficient business plan that might result in a $100 million exit, but maybe you can get there on less than $10 million worth of capital, which wouldn't necessarily be a bad deal for everybody. But if you've got a multi-billion-dollar fund that doesn't move your needle, you're not going to support a company like that. So anyway, that's my riff on where the market is. It's coming back to, I think, reality. Fundamentals are more important. I think it's healthy. I think it's good. Private markets always lag the public markets. So what you've been seeing in the broader public markets, hopefully is some positive sign, although the NASDAQ has still been a little bit volatile. Even though, of course, as we know, the NASDAQ's heavily weighted the big 4 or 5 tech companies. But I think we're going to have a muted year in 24 with a slow comeback trajectory. And I think everybody's waiting for 25 where things will be a little more exciting, hopefully. But venture capital, always bullish, always long. Technology always changes. There's always opportunity. There's still a lot of money out there. and the money needs to be allocated, and I just think it'll be allocated in a more smart way than we've seen the last few years. There's my editorial.
I'd love to know about companies' progress that you're seeing in terms of marketing and how they're getting the ground going with especially B2B marketing, because I feel like there's a big difference between budgets that allow you to get customers and budgets that don't.
Look, we've seen, in a broad sense, again, everything we're saying right now is very macro, that there are budget pullbacks in certain categories amongst particularly, larger companies. So those budget constraints are real. But I'd like to think a seed stage company where the bar is pretty low. You're starting out at, we come in, you might have a few $100,000 in ARR. If your objective is to create $100 million revenue business, I think lack of budgets or budget constraints is not a reason why products are not getting traction. I think you have to go back and think about how you're positioning your product, what the value proposition is to your product, how you're pricing your product, how you're segmenting your customers, how you're prioritizing your go-to-market, really understanding what your sales funnel consists of. Because if you are solving a really high pain point problem, there will be a buyer for that product. If you're not, there won't be. And I think that's what's happening right now is the nice to have companies, sadly, are going away. They're just not going to survive. And I'm not saying we're perfect at picking, by the way, we have a few of those. But more than ever, I think founders really need to be honest with themselves. Are they solving a pants on fire problem, particularly if they want to raise venture capital? And I think every founder should keep in mind that venture capital is a particularly specific form of financing to build scaled businesses. Again, multi-$100 billion plus businesses. That's our industry, because the economics of capital allocation to the risk in portfolio management, it requires outliers. Otherwise, we can't make money because there's too much uncertainty at the early stage to get it right all the time. Yet there are really great businesses that we see that could be terrific businesses, that could be $20, $30 million revenue businesses that maybe could grow at 5 to 10% a year. That's not a venture capital trajectory, but if you can found a business like that and finance a business like that, that's very exciting for everyone involved. And I'm not even saying that equity isn't necessarily the way to finance a building business like that. If it's super equity capital efficient and there's angel interest, because an angel has a very different economic return paradigm than a venture capital firm does. So again, as a founder, you can build great businesses that will never see $100 million, but they're not venture backable businesses.
I mean,
I'm sorry, I don't know if my audio went down.
David, quick question. Do you guys do postmortems on companies that don't make it through?
The sort of the anti portfolio that we did not invest in?
No, companies that are in your portfolio that fail, and because you guys have a highly concentrated portfolio.
We do.
And you guys are noted for working side by side with your founders. In particular, we share a co-investment in Noteworth. You may want to update your webpage. It says it was acquired, but
well, technically it was. It was
okay, technically. Yeah, okay, pennies on the dollar.
But I mean, like I will say, there was a Wall Street Journal headline many years ago that said the venture capital industry buries its dead quietly. There's truth to that. So, but I'm sorry,
No, but do you guys do postmortems on with internally?
We do.
Okay.
We do. We sometimes do it to the extent of complete and utter self-flagellation. Yes.
I know him and his partner. I believe that. I think I forgot to have Matthew introduce himself. Matthew, did I was your name jumping around and I missed you? Didn't mean to be rude. Oh, maybe not. So, Mark.
Yeah, I'll follow up. I was going to hold this off till the end and let more important people talk. But since Joseph mentioned it, I noticed on your website, and I don't know if it's because, I don't think I've ever seen this before, but it could be just my memory, which isn't what it used to be. But I don't recall any VCs putting on their website identifying companies that have been shut down. I'm just wondering the reason why you publicize that. There's got to be some rationale behind it. I thought it was very interesting, though.
Well, we have winners and we have losers. Noteworth is a little triggering for me. That was not a wonderful experience. I'll just say that. I think I'm not speaking out of school. Part of what we feel, how should I say this? I don't want to, we're not self-righteous. I don't want to sound that way, but we just want to put it out there that this is, let's identify the elephant in the room. This is a really hard business to be in. And you make great picks and you make some really terrible picks. And that's the reality of it. And we have always, particularly on our LP side, we've been super transparent and candid about how we go about our business, how we source our deals and diligence our deals and manage our portfolio. And we keep them very, very abreast of the status of our portfolio and the companies. We're very conservative, frankly, internal with our marks to our LPs. So putting out, look, we make mistakes, we're human. It works for us. And maybe it's strange. It's why we do this venture co-op program 2 or 3 times a year. We have over 100 people go through it. It's essentially a master class in venture capital. The curriculum was created by our partner, Jerry Kirilova.
Yeah.
She leads it. She's amazing. And part of why we wanted to do it is just to demystify venture capital. With, if we can democratize this industry just on the margin, we're doing our bit. We think that's good for the industry. It puts people out there, frankly, who are eyes on the street for us. So there's a quasi scout component. If somebody does find a deal for us, they would get economics in that deal. But we just want to open it up. And I think part of just being candid about this industry certainly helps us. I think it's good for the business. So many people, the average person has no understanding of what venture capital is. And frankly, if you press them, they probably have a very negative opinion of it, even though they don't know what it's about. And that's unfortunate, because I do think, allocating capital to young companies that are innovative, to amazing founders that you invest in and sometimes sadly fail to invest in. It's a privilege to do it, and it's a necessary part of our economy. But we're trying to break down some of the networking barriers. I was reading, this was probably now about 7 years ago, 8 years ago, that 40% of all general partners in venture capital firms attended either Stanford or Harvard business schools. That is a crazy manifestation of network bias. And I don't think that those of us who went to Harvard or Stanford don't like the people who went to Columbia or Penn, right, or Wharton. It's just systemic bias, and that's not good for our industry. Even at New York Angels early on, when I was an active member 15 years ago, you'd see founders, very smart, ambitious young people who absolutely should be in the room pitching their businesses. But the vast majority of them have gone to, fairly name brand schools and seemingly come from at least the top half of our society. Well, why is that? Because a founder is going to underpay themselves for a number of years. And if you have school debt alone, you're not going to be able to have that job. So it skews to people who have more privilege. And if we can open that door, because there's so many smart, creative people out there, I think that's just good for the business and good for the industry, and it's good for us, and it's worked for us. So again, sorry, I get on soapboxes.
No, I appreciate it. It's good to see that, because I've been in the investment banking with tech companies. We know the failures that are out there. We've had several of them approach us to try and save them when they're really not savable. But we also have the same reputational issues that VCs have. Most tech company founders don't know what an investment bank is, what they do, and when they do, what they do know, for some reason, it comes off as being negative. But we try and change their perception.
Yeah.
There's 2 things I wanted to add. One, as I'm sure David is aware of, Bessemer's anti-portfolio, the deals they neglected to invest in, and it's pretty funny because some of them are huge hits. And Jason Klein, speaking of the New York Angels, Jason Klein just joined us on. I want to give Jason a chance to introduce himself. You're muted, Jason. Oh. Jason? Well, he is here. Maybe he can't talk at the moment. So,
Hi, Jason.
I know it's a New York Angels thing. So
Yeah,
next
Jason
question.
Owen.
Anybody have a question? Ian, you always
Yeah,
have.
I do. I do
Yeah.
actually. So,
Go ahead, son.
thanks.
No, it's good. Go ahead. I'll be next.
Okay. So I represent kind of a weird middle ground in that I've started a company that's largely de-risked, but is not in any danger of doing 3x revenue. We're growing at 30 to 50% per year. Maybe we'll double in the next couple of years because of the AI boom. But we're not positioned to be $1 billion company. We're positioned to be $100 million company. And apart from equity crowdfunding, it's been very hard to find investors for a company like that, even though we're substantially de-risked. Because I take the point of view, and I suspect some of the other folks on this call do, that I'm a data set of one. For a VC to say I have a portfolio of 15 companies and say 12 of them are going to fail, but that's fine, is not a risk profile that's acceptable to the individual CEO. Particularly, I'm not a spring chicken. If I was 20, I'd say, hey, if this one doesn't work, I'll start one when I'm 23. But you start getting up there, it's like this one has to work, and you get a little less open to the idea of churn. So the question is, what kind of funding options would you recommend for a founder like me? Because it continues to be a bit of a mystery.
For an institutional investor to invest in a company where the outcome most likely is $100 million. And, let's put it in perspective. If you really can create a $100 million company on a liquidity event, that's a huge, 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 huge accomplishment, right? Few people are able to do something like that.
Right.
But when you're building, let's say, 20 companies in a portfolio, which is a small portfolio, if we did a portfolio, even if we got some confidence around de-risking, but the outcome potential is 100 million, and you've got to return 30 or 40 million to your LPs, and you just start doing that math, and you're not going to get there. And look, it's not acceptable that 12 companies die. Fortunately, we in our first fund, most of the companies actually are still alive. We've had some good exits. It's been an amazing fund, that fund. But although we don't need, like maybe a Bessemer needs, $1 billion outcome, we can't plan for a $100 million outcome. Now, if that's what happens, right? We've had some companies in the portfolio. We have one right now in the portfolio that has been cash flow positive now for a number of years. It grows at like 20% a year. They've raised $2.2 million ever. We were the seed on it. And I think at some point in the next few years, they'll exit probably, I don't think for 100 million, but maybe $60 million. And the IRR on that's perfectly fine, right? That's just not a deal I'm going to lose any sleep over. But it's also not a deal that's going to return the fund. And we've learned that, so in our pre-institutional fund, we had one company called Triple Lift, which was a unicorn outcome. And that returned everything that Jeff and I had been doing prior. And then in Fund 1, we've already had one that more than returned the fund, and it's been sort of the outlier. There's another one in there, fortunately, too. In Fund 2, we have another one that is, going to 2x the fund on that one deal. And we're hoping we can find it for Fund 3. And what we've learned is the power laws of portfolio management investing, particularly when you're looking over a long time frame, because as institutional investors, one of the things I realized that we realized when we got into this is it's a 20-year commitment. You're going to have 3-4 funds. To your point, the fund lives are 10 years each. The average now in the industry to an exit from seed to exit is over 8 years. So these are long hold times, long fund lives. And over the course of 50, 60, 70 investments, the power laws just kick in. you'd like to think that you can always beat it, but you don't. And hopefully over that 20-year period of time, from our perspective, that we can give our LPs an IRR return. That is, if we can do 15% a year over 20 years, that'd be amazing. That's really amazing performance. And that's what you try to do. And if you can do, much more than that, great. But to sustain it, I don't know if I'm making sense. So that's why it's just hard. It's hard.
Yeah,
It's why
no. And I understand that we're not a fit for VC in most cases.
Yeah.
But the question is, are there, how would you, if you were me, how would you go about approaching the funding?
Well, I think, it is. It's the friends, family, angel world. It's structuring your company and your financing to make it attractive to those who want to write, $25,000, $50,000 checks. Create a structure that gives them, you can give returns, you can have dividends, you can have notes with interest. I mean, there's all sorts of ways of returning capital that don't require a terminal exit. So you can structure things that are attractive. Always manage cash yearly. If you really can build the business at 20% a year growth and do it on some kind of cash flow basis, there's debt. Debt is still.
Yeah, we actually did venture debt, a couple $100,000, and that's worked out well.
Yeah, and then there's some good venture debt providers out there. And most companies in our country are financed through debt, not equity. That's not easy.
Thanks.
Yeah.
So next question, feel free to raise your hand.
No, I wanted to follow up on the David, the VC scalable versus internal growth oriented, information you're sharing with us, because it's always funny to get back into a VC's head about how the uniqueness and product market fit that entrepreneurs are always thinking about aren't really, I think, your day-to-day life. Your day-to-day life is looking at traction and seeing if there's actual money coming in and if there's a real business there. But that said, I do want to press you a little bit more on that differentiation. How do you determine if a new category is just a new version of an old thing or a real true opportunity, besides traction, which is obvious?
Yeah. Look, I mean, again, it's hard. We don't bat 1,000 by any stretch. One of the things that we do, at least in our diligence process, is because we have a pretty vast network across many, many industries. When we enter into diligence, we'll put a founder in front of 3, 4, half dozen prospective customers, and let's hear the pitch and let's see it in real time, and let's get feedback from those people who are in the industry or potentially their customers, and see, is this a product that is resonating? So that's a data point for us. Granted, it's anecdotal, it's not any kind of science. There's certain things, that there seems to be obvious inevitability to some of the companies that we've invested in. Our company, Acrolis, in the second fund, which has been a magnificent investment, and they digitized the processing of financial statements in the loan industry, mortgage industry. And this was a very manual process prior. And it just seemed very inevitable that somebody was going to digitize this. Sam Bobley, their CEO and founder, came to us in the fall of 2017. So yeah, the puck's definitely going there. So the question is this a team that's actually figured out the right solution? But there was no question that the way business was being conducted around that workflow was absolutely going to be different 5 years later, right? And we were right, and we were fortunate in finding a team that could execute on that problem. We do see a lot of redundancies of solutions, a lot of platforms that really aren't platforms, they're more features to what should be maybe a larger suite of product. If this really was a science, right, we would all of us on both sides of the table be a lot richer. there are differences though, as founders, understand the differences amongst VC firms, not only just in focus, stage of investment that they participate in, but their own economics. There is a huge difference in terms of the economic incentives of a multi-billion-dollar fund versus $100 million fund. Very, very different. And there's a place in the market for all of us, but they do different things at different times for founders. That makes some sense.
Ian.
Yeah, I just wanted to go back a little bit to what you said about the difference in motivations between angel investors and VCs. So you've mentioned that most companies in the US are funded by debt, not equity. But I think you also mentioned that angel investors would be more interested in companies growing at 15-20% a year.
Sure.
Is that what you meant to say?
That's my perception of it. I mean, I was an angel for a number of years through New York Angels. I've got to meet a lot of angels, and I think angels are, first of all, angels don't have to return capital to LPs.
Got it.
That's a huge difference. When you've got $50 million of capital that you've got to return to an LP base before you get any return whatsoever, that just puts a lot of, there's math to that that's driving the decisions, right? As an angel, I don't have that requirement.
Right. Yeah, that makes sense. Now, the other question I wanted to ask is about strategic investors. Maybe people don't talk about in our case, that's mostly who we're talking to now, right? And it looks like it's a much more promising avenue for us than even angel investment, because some of these people are quite well funded, but they would have like a vested interest in partnering with us or performing some combination of their activities with ours. So what is your feeling of both?
I should have mentioned strategics. They have a role. I think, but I mean, the strategics too, they come in different colors. There are strategics that really want to have more of a partnership relationship. There's strategics who really are in effect outsourcing R&D. Many strategics do this because they want to, frankly, purchase a successful company young and early, rather let's buy the team and the basic technology for 30 million rather than 300 million, 3 years later. And it depends from a founder perspective, what it is you want to do and build and what you think, and what you're trying to create, right? Because strategics can get in the way, particularly if they get in early as well.
Right.
And there's, competitive issues too. The strategic may not want you selling to their competitor, which could limit how you move in the market. Early on, strategics could be a negative in terms of institutional venture capital, because the VCs may say, oh, wait a second, this is too dominated by the strategic or too limiting in some way. So again, I think, one of the things that we talk about with our founders, and particularly in the diligence process, is really having thoughtful alignment between your operating plan, your go-to-market plan, and your capital strategy. And capital is a strategic lever, and there has to be alignment. How does the capital help you realize the vision that you're articulating quantitatively, and qualitatively, but quantitatively in your pro forma P&L? And it goes beyond just mere use of proceeds. What is it that you're trying to build? How big of a company are you trying to build? How efficient can this company be? Is it a company that needs a tremendous amount of capital to get to a certain objective, or is it very capital light? None of these are right or wrong answers, right? There's so much in our economy that requires massive capital. And those are good things to be built, and there's capital providers for them. But it's not, I think many founders see, every dollar the same from any source. And that's just not the reality, and that's dangerous.
Well, that's very helpful. Thank you.
Neil, sorry, I was muted.
No worries. Thanks. David, I guess I'd love to ask you, given your background, I think is in media, and you mentioned Triple Lift, which is an ad tech, both sectors that are pretty negatively perceived right now by VCs. As an entrepreneur who's been in media tech with a exit before and lives and breathes media, I'd love to hear your advice about just what's the approach around raising capital from VCs around media at this point, given
it's been out of favor broadly for a while
for a
now,
decade,
right?
yeah, over a decade now. Well, BuzzFeed, there's a slew of companies that raised maybe about a decade ago, but yeah.
Look, I think, the media industry, and Jeff also came out of that. If Jason's still on, Jason's a media guy. I think there are a lot of us, particularly of a certain age, that started out our careers in media, and we wound up, in tech. And the reason being is the media industry was one of the first industries that was disrupted by technology. So we were kind of the canary in the coal mine, if that's a good metaphor or not, of what technology can and cannot do and how it can be applied. So consequently, there was a tremendous amount of money, right, that flew in. If you go back, 20 years ago, that flew into the media industry. It was crazy, absolutely crazy. And I started one of the first online ad networks in the late 90s. It was nuts how much capital was flowing in. And so consequently, a lot of problems were solved. And I think we've been in a little bit of a media MarTech lull because there was this whole generation of platforms that were instituted. However, I mean, there's, again, if you find those problems, I would never say blatantly. I'll always look at a media or MarTech deal. We have one in our current portfolio. That's a fairly exciting product, a company called Marpipe. So we're not anti it at all. Again, if the fundamentals are good, if the business is a good business, if it can grow at certain growth rates, you'll get funding for it, even if it's the media business. But yeah, there's no lemming effect to that industry at all. I don't know if that answers the question.
Yeah, no, thank you. Yeah, just trying to plan my attack for this year, given where I am.
Look, if it's what you know, right?
Yeah, it's what you love too.
Yeah.
So you got to do what you love.
So next question. And feel free to ask or raise your hand either way. Otherwise, I'm going to tell my Triple Lift story.
Hey, David, it's Tanya. Thanks for some really insightful points there. I was just curious if you're willing to share what would be a good ROI for a company such as yours at the portfolio level, but even at an individual investment level that you would look for.
Well, you're hoping, for the outlier is 20x or more. You don't really want to. You want to have some confidence that at the very least it can do 10x. And of course, with all that planning, sometimes it does 0. And if you can sometimes get out whole, you're happy. But even going into a Series A, I think Series A investors, they're always going to throw a minimum 10x potential on it when they're looking at it. So getting back to, let's say, valuations, if you have, which we saw, if you were, post money on a seed deal of $20 million, right there, the market's expecting you minimum to build a $200 million outcome. And it's much more nuanced than that. But so again, it kind of gets to the math of things.
Absolutely. And I'm sure there's obviously a time value to the money as well. So curious, in terms of exits, what types of exits are you seeing nowadays? That
Few.
Yeah.
Honestly, I'm not expecting a liquidity event in 2024 for any of our portfolio companies. Right now, their mission has been heads down, grow revenue. We've done some bridge financings. We've done some smaller Series A's. And we just want to grow and manage cash effectively. If it makes sense to get near a break even or have some a real leverage where you could push yourself to break even if you needed to extend runway. That's where the focus right now is on exits. Most exits in the venture industry are M&A. 90%, I think, is the number of exits, frankly, are sub 250 million. So that gives you a little bit of color on how hard it is when you start sailing out into bigger numbers. I'd love to see, it is connected in some sense. I'd like to see the public markets be more open to IPOs because that has an effect right down through the food chain. But M&A is still the bread and butter.
Yeah.
Venture capital liquidity.
Sure. Thank you.
So next question. You don't have to be shy. This is a very friendly room. Oh, I'll call on Tina next. I'll get you. Ian.
Yeah, thanks, Bonnie. David, so I'm raising an angel round. It's $1 million. I'm expecting that it self-funds itself with 30% EBIT after this first kickstart. And because we're taking because it's an $18 billion super antiquated, super inefficient business, and we're approaching it with a geographically distributed zero assets model. I think that we could provide some pretty insane returns to angels, or even to seed level VCs or even pre-seed, because I don't think we need that Series A or the Series A will be discretionary, put it that way. Is that said, we seem to be the first of a kind, and although there are analogs, there are similar examples in when T-shirts were starting to get digitally printed, or coffee mugs with your family, and then you've got Vistaprint and you've got the FedEx print shop, or even the Dell model, and so we're replicating that in a industry that's highly resistant to change, except for we found the niche that makes it easy. And we've developed the tech, we're operationally de-risked, but we're starved for working capital as we're going to market. Do you know anyone that's willing to look at weird industries like cabinet making?
In some ways, I guess we're all looking at weird industries, but not directly. It doesn't resonate immediately. I think if you are raising $1 million, if you feel that $1 million gets you to a cash flow positive position, and you can organically grow the company without raising more capital, that's probably not a VC deal. So the angel groups, New York Angel, the HBS Angel, all the angel groups are certainly folks that you should go to. At New York Angels, when I was there, we did obviously a lot of tech and software, but we did Tommy John's underwear as well. That's kind of quirky to me. Wasn't something I thought about as a vertical, and proved to be a successful investment. It's networking and just finding people who are interested in this. Raising money for all of us is just laborious at best. And I've been raising money my whole life. As a VC, raising money constantly for your portfolio companies, from your LPs, it never ends.
Go ahead. Go ahead, Tina.
No, that's it. Thank you.
No, I was going to say Jason Klein is here. Jason actually runs the Harvard Business School Angels, the New York chapter, and is also one of the New York Angels, and unfortunately is having technical difficulty today. I think but I did want to mention that.
Well, I'll put info in the chat. Anyone can pull up. Thank you.
Ian.
Yes. So David, you mentioned segmentation as something that I guess you recommend to your portfolio companies, or improving segmentation. So that's what we're trying to do right now, is identify higher margin segments. I mean, do you have any suggestions or ideas on what are the ways that we can do that?
You know, it's
know
understanding, right? I mean, I think it varies by industry and understanding, you know, who the potential addressable market is and what are the potential segments in there, right? So you can segment by, you know, size, you can segment by geography. You can really understand an industry. There may be segments that are much more open to new technology than other segments. There might be segments that have more robust budgets than other segments. You know, effectively, you do want to try to find where the proverbial low-lying fruit is, where you can demonstrate traction and define a certain segment. Say, well, here is niche as this segment may be. We think we can dominate or get 10-20% market share quickly out of that segment, and then continue to move into the other identifiable segments. And that's another way to show. Again, it's just trying to figure out the challenge, I think, for founders is figuring out what is achievable.
Right.
You know?
Yeah. I mean, I guess we found that there's a lot of randomness to it. Like there's obviously a lot of networking that goes on, and every once in a while you just discover something that you had no idea about,
Yeah.
And this has been really a revelation to me. So, so we're an online school and we teach live. So there's a kind of a limited growth rate if we just keep going that way. But we found some potential customers that have very specific needs that we actually are a very good fit for. And it wouldn't be a huge market, but the margin might be a lot better with somebody like that. So that's what we're, trying to look at right now. But do you think that most founders or most startups do a good job of segmentation?
No. I don't. We, as a team, I mean, there's 4 of us on the investment team here. We see thousands of deals a year. Most of them we can make a decision on in about 30 seconds. Most of them lack rigor in their planning. They lack. I'm too often disappointed in the P&Ls that I see. The lack of, again, granularity to them. Not understanding. That's the other piece. It's when we push a founder in diligence to be precise on a pro forma P&L, on frankly a simple document, which we always enjoy seeing, is just simply a pro forma org chart. Show the vision visually of the company that you want to build and the various positions that you feel need to be filled, that have to be played, and how those positions relate to one another, communicate. The org chart's a simple document, but it's a very helpful tool. And what we stress to them is we're not asking you to go through hoops. You should want to have these tools as a manager. Every month you should be benchmarking what it is that you did in this month and what was the outcome and what was in your control and what was not in your control. And can you institute more of what's in your control? And there are many, many that struggle with that, or to be fair, they don't have experience with it.
Right.
I can get into other things that go
Yeah.
sideways.
Well, I mean, I'm curious if you have any sample documents that you would regard as good examples that we could have a look at, or it could point us in some direction where we might find such examples. I don't know. I mean,
look, one of the things, if you want, we'll probably be doing it in the second quarter, jump on the co-op. Right. And we do, in that context, we provide a tremendous amount of resources for the participants. There's no cost to it.
Right.
Try to show people what we think are good practices.
Yeah.
I do believe that starting a company from nothing and having a successful liquidity event, and frankly, whether that liquidity event's $20 million, $200 million, $2 billion, is an enormous achievement. And I think it's the hardest thing one can choose to do in the business world.
Yeah.
Just hard. It was why I became a VC, because my 4th company was a failure. And I was at a speaking event, venture capital speaking event with a buddy of mine who was a VC. And it was a very prominent super angel who was a keynote speaker. And he was talking about, building portfolios. And I said, you know what, I think I want to do that. I think I want to try to, in effect, hedge through diversification of ownership. Rather than being a founder, it's always at least a 3-year commitment, and it could be easily twice that. And there's only so many one can do. And this is a life I've wanted. I mean, you can go back to my business school application. I talked about how I wanted to be an entrepreneur. It always seemed exciting to me, and it seemed a career choice. And that's another thing we look for. We particularly amongst young entrepreneurs, they get a little bit of a notion where they're one and done. They're going to start this company. They're going to have this multi-billion-dollar exit, and then it's houses all over the world and jets. But the reality is 99% of us are working entrepreneurs. It's what we do. We will have multiple companies over the course of our entrepreneurial career. If we become, a movie star, terrific. I mean, it's great if you have $1 billion outcome. Most of us won't. And that's okay, because you can do fine financially, and have a nice life, and send your kids to college and all the good things that we want in life. And I think that grounded founders, and I'm not saying they shouldn't be ambitious and you shouldn't, swing for the fence, go for it, right? But also understand what it is that you can build, understand what it is that you want to build, understand what is being asked of you to build it. I've had conversations, with one of our near unicorn companies, and we had a lot of board conversations about, do you want to, as a team, venture out into that deep blue sea? Right. Or are you okay where you're at? Because if you're okay where you're at, and this is probably where we're and our co-investors can be quirky investors, because it's like, if you sell it for 300 million, you're going to make a lot of money for yourself. Everyone's going to do fine. If that's really emotionally, I think it's an emotional decision, where you're at, and that's the outcome you want, great, terrific. If you want to add another 3 to 5 years and try to take the risk and sell out to unicorn land, fine, we'll support you to that. But that's, a lot of it's personal, a lot of it's mindset. What is it you want to build? And good VCs, I think, try to help founders realize what it is that they want to do. It's, there are some good VCs out there. It's not all about, $1 billion or bust.
Yeah, so there's more than one acceptable outcome. You can take a certain level of success, or you can shoot for something bigger, but neither one is bad.
Neither one is bad. Look, we have, there's one of our founders who was an amazing founder. The company didn't work out, but he's great and absolutely would fund his next company. He was incredibly transparent, communicative, rigorous and disciplined, did everything right. It's just, it didn't work. Okay.
Yeah, it's the way the game works out. But anyway, the co-op sounds really good. So I'm definitely going to be checking that out.
Yeah, I think you'll enjoy it. I really do.
It really sounds good. Thank you.
Gary does a great job.
I'll make sure to put it in the newsletter as well. I know it's on your website. Sandra.
I actually wrote my question in the chat, but I'd really like your best advice on an emerging brick and mortar equipment process-based company that's in the wellness space. What does that picture look like for them finding investors, or what would investors be looking for? Is it friendly? Why or why not?
Well, I'm a software investor, so it's hard for me to speak to brick and mortar, and we're B2B, and I have, since I was a little kid, I'm just terrible at consumer products. My dad used to joke, if I liked a TV show, it would never survive the first season, that he should sell me to NBC. If I like it, they shouldn't make it. I have weird tastes. But anyway, I have to, software gets venture capital, at least in the ecosystem that we live in, because, the margins are massive and the growth can be huge and it scales. It does all these wonderful things, at least in theory, that brick and mortar struggles with. I don't have contact to or exposure really to brick and mortar venture capitalists or sources of finance. It's not really a world I cross into. I have to imagine if you have some form of scalable template around brick and mortar with incredible unit economics, and some kind of efficient repeatability, because even brick and mortar needs scale if you're going to go for venture capital. So as long as you can demonstrate that, but again, I don't know who the players are in that world.
I left out a key word, which is franchisor. So that is how they intend to scale it.
Okay, and those businesses, obviously, when they're successful, they can be enormous. And I don't, I have little understanding of franchise businesses. I don't, in principle, I just like to think if you're solving real problems and filling real needs, and you have a business plan that has insightful, rigorous deficiencies, capital comes, but you got to do like everything. It's just an enormous amount of elbow grease work. Again, finding sources of financing, networking sources of financing, building a process of capital raising is really, really, really laborious, tedious work. It's not fun. I just want to meet the person who enjoys raising money. I don't mean to just kind of default to platitudes, but and and believe in it. It's a lot of stuff. The cliche is kind of true. I think when Jeff and I decided to institutionalize in 2014, there is a lot we didn't understand or know, and we would have been really intimidated if we had known it then. And I'm kind of glad there was a little bit of ignorance, but a willingness to get on a steep learning curve and really embrace it and be realistic. There's nothing wrong with starting a company and saying to oneself, you know what, this isn't going to work, and I'm going to stop doing it. I think in the way a VC says this is a go or a no-go, founders should say, is this a no or a no-go? It all applies, because otherwise the thing that kills most companies is wishful thinking. I see it over and over and over again. It's why too, we'll see companies that'll pitch us and they'll have like these 4 or 5x growth rates over 5 years, and they think it's what we want to see. And first of all, it's like, gee, you don't have to do 4x. If you did 2.5, we'd be all happy. So why are you even making that a goal for yourself? And what we really want is to understand what's possible. Because at the end of the day, I'm going to give you money. You're going to give time, your life to this. It needs to work in reality. It's not a sales thing. That's why if we meet founders that are trying to just get our money and close us and be salesy with us, and if I overcome this objection, will you buy from me? Right? It's like, go away. We're going to be together probably at least 5 years in a very intimate way. And we got to be real with each other. I mean, it's maybe a little cliche, but it's like getting married. We're going to find out the truth of each other one way or another. Let's put it up on the table before we exchange vows.
So what I hear you saying is there are rules that apply regardless of industry. You got to dig in and follow the rules, and then hope for the best when you do everything right.
Yeah. I think that's right. I mean, business fundamentals, I think it's why Jeff and I have felt comfortable, and now Jerry and Miret, who is our associate, business fundamentals aren't really that different, right? It's understanding your unit economics, who's your customer, are you pricing things right, what's your distribution plan? I mean, it's all the same stuff. And you just have to think through the devil in those details. And yeah, there's some randomness to it too. I mean, look, there's no question, right, that there's some really good business plans that just don't raise for whatever quirky reason, and they should have raised. We've had them in our portfolio. We've had companies like, Jesus, this is just a really good company, and for whatever reason, timing, out of favor, whatever, we're not getting the capital that we want, and it's very frustrating. But that does happen. There are sort of dynamics out there that you bump up against, and you just have to accept though that is also the reality, because this is a market, and markets are human processes. They're not the notion that markets are always right, always efficient. It's silly. They're not.
Thank you.
You know, I wanted to mention something you said at one of the breakfasts and you just touched on it again when you were talking about the relationship, and you said, you know, how often have you heard that getting into bed with an investor is like a marriage, and you said it's not. Do you remember what you said? You said if the marriage goes south, you can get divorced. You said you are stuck with the investor for the life of the company.
You know, I guess you can. I mean, all divorces are painful, I guess. Yeah, I mean, I actually think I was reading Union Square Ventures, and they're as good as anybody in the world at venture capital. And I believe they just finally wound down the last liquidation on their first fund, and I think that was 19 years ago was the vintage. So these relationships last a long time. Look, we now in Fund 3, we have some founders who are LPs, which is just amazing when that happens. You know, the things come full circle. I mean, you do develop genuine friendships with your founders. You care about them, and you should. I just, you know, it's like, you know, why would you get in the music business if you didn't like music? Why would you do this as a job if you didn't like business formation? Really like the people who build companies. Not to over romanticize it.
Next question. You know, Ray made a comment in the chat about how some VCs are very arrogant, especially the younger ones. You know, I saw an article recently that said that crowdfunded startups have a better success rate, just by several points, than investor funded, whether they be angel or VC. And I wonder if it's the wisdom of the crowd. You said, you know, you don't understand why people can't see what you can see. And I wonder about the wisdom of the crowd, but I think it was a 5-year cliff. They're much more successful.
That may be. Again, power laws kick in ultimately on things, and maybe, I don't know. You know, we always wrestle a little bit with, you know, the subjective component to this and the objective component, and you can be confused about what side you're thinking about while you're thinking about it. Sometimes we joke here that maybe there's just 2 buckets of VCs. There's the competent and the incompetent are just the ones that, you know, aren't disciplined. And with that, you have to at least be disciplined. And the rest of us just kind of fall on some kind of distribution curve. And over time, you know, I don't know. I don't know what. If this is just, no one's written the textbook, and there's been a lot of books written about VC, but no one's written one that if you follow all of this, you know, you're going to have 18% IRR for 20 years. Doesn't exist.
That's true. Why is that? There's some very successful funds out there and some very successful investors.
Yep. It's a hit-driven business at the end of the day. It is very analogous, I think, to the film industry, music industry. You know, why was Clive Davis so good? I don't know. And why can't he be replicated? You know, at scale. I do not have answers to these questions.
So, David, what's your view on that? You must have a great intro in. So, I spent 25 plus years traditional finance. I have a tremendous financial network. However, they're more in the capital markets game. So I have tremendous technology. I have patents. I have stuff that the US military has used for 22 years. However, the 28-year-old says, DM me, and then they won't get back. And then they said they did PayPal, except they were 10. So what's your view on that?
So give me a little more. I'm not exactly sure the question you're asking.
Okay, I'll leave the editorial out. There's a lot of view that you can't speak to many VCs unless you have a direct introduction from someone they respect.
Oh, I disagree with that inherently. first of all, everything that comes through the transom at Laconia, we will look at. I think most VCs will do the same, whether we know you or not. Most of the deals that we have done have come through warm introductions rather than cold calls. And I don't think it's because of the fact that the introduction is warm. I think that it's a little bit of a filter in that the founder who's able to figure out how to get to us that's a sales skill. It shows problem solving. It differentiates capability for those who are able to do that. But the fact that, Charlie says Susie's terrific. Yeah, we're still, I don't know if that in and of itself really matters. Maybe all things being equal.
Got it.
Yeah, but I think it's easy to get in touch with VCs. And the other mistake, this is another thing I find, and it upsets me too, is that we'll have a few things that go on. We'll have a founder who reaches out to all four of us at once. Please don't do that. Choose one of us. Because what happens is then we don't know that the other knows, and it turns into a cluster for us, just logistically. The other is where someone will get in contact to our associate, but then not want to engage the associate on a pitch. They demand that they need to meet a partner, or they'll talk to the associate. The associate will say no, and then they'll reach out to me and say, well, our associate already said no to you. So now you're going around a truly trusted team member source in my company, and I don't appreciate that. I don't know, where am I going with this? How you interact with us, how you behave with us matters. We're not hard to find. I mean, you Google me, I'm all over the place. In fact, my wife hates the fact that I'm so public, and all of us are. So we're not hard to get to. I've never really understood quite that problem.
And thank you for making that point about when the associate vets it, and I'll be asked, well, don't you know somebody else in the fund? I said, I can't go around the associate. It's like they work. It's not how it works.
Not how it works. The associates run this industry. You want to know associates.
Yep. Oh yeah, they're the gatekeepers.
Totally. You want to know
totally.
Them. And one day the associates become principals and partners.
Yep.
So you really want to know them. And there's a long game. Long game. There's successful founders who their first company never got funded, but the second one got funded. That worked. And those founders who maybe said no, might have even invested in the second one. How you treat people is really, really, really important in this business. Any business, I would assume.
And people remember.
They do. They do. It's interesting. When you break up with a founder, you say no to a founder. You learn a lot about the founder. We joke we should just ostensibly break up with them and see how they respond as part of the diligence process. I've had people get angry. I've had people get really short and curt, and then you've had people that are, gracious and wanting to understand and learn and want to maintain the relationship. And there's been times where there's a few of our portfolio companies where we have said no, and 6 months later or whatever, we've said yes. Because they continue to show us, all right, the good news of the company. And we realize, wait a second, maybe our first call on it wasn't right.
I always tell founders to follow up, keep people in the loop. Very important, because you never know. As I said, one day I wrote an editorial called "No" is an acronym, stands for not ordinarily. In fact,
there's the old Woody Allen joke about how you beat 80% of the competition by showing up. And there's a corollary to that. You can beat the other 20% by following up.
Yep.
Yeah, you're so right, Bonnie. The lack of follow-up is astonishing.
I got my first job, which was at NBC, and it was a job I really wanted. And I did 5 interviews, and I got this rejection letter from a vice president I'd never met. So I called him. And his assistant said, does he know you? I said, well, I'm holding a letter from him. And so he took the call and he said, oh. And I said, I just want you to know that you made a terrible mistake. And this is why. You know, he ended up hiring me. He created a job for me.
Wow. Wow. Yeah. Look, and it's also about, I think, the following up, you don't want to be a pest. I mean, that's silly. You do want to, present value. I've had some people whose follow-up, over the years, it's just been wonderful. I mean, you look forward to hearing from them because they're going to, give you some insight or something. There's something of value that they just, even if it's very tiny, you never feel like they wasted your time. And that's cool. And that's a skill. I mean, so maybe even a gift. Again, long game. If you're going to be an entrepreneur, particularly if you're, in your 20s, you're going to be playing this game for 30 years. This is a small industry. Play the long game. You have many companies. You want to meet all the right people. And hopefully there's some fun in that. The networking piece can be fun. I've enjoyed networking with you, Bonnie.
I've always enjoyed networking with you. And I forgot that that you and Jeffrey weren't part of the New York Angels, although I would have been, if either of us could have made it to the party, it would have been good to see you.
It would have been good to see you.
Is there
Laconia owes its life to New York Angels, because that's how Jeff and I met back.
That's right, I know that.
Randomly sat next down to him. We were newbies and instant friends.
I knew that. So is there one last question? We have time for one last question. Or I'm going to ask David to impart some pearls of wisdom or warnings.
Oh God, I think I've been soapboxing now. I'm amazed that there's still people on the call here.
I know things are picking up. That's why I think people had to jump off early.
No, I don't know. Pearls of wisdom. Hopefully, whatever I've said today is worth a little more than the price everybody paid. So, I mean, the cliches are somewhat true. Follow your dreams. You got to do something. You got to build a company. Go build it. Just be real about it. That's all. The wishful thinking piece gets you in trouble. And saying no to a project, it's not the end of the world.
Ian called you the voice of reason, which you very much are. So
well, thanks for having me.
Thank you so much. I always enjoy having you, and I will invite you back again, not to worry. So I want to thank you all for being here. And we'll be back in 2 weeks with our next investor. And thank you again, David. And tell Jeffrey I said hello and I still love him. And Joe.
Pass it along.
Okay.
Thanks, everybody.
Have a good day, everybody.
Bye-bye.